Well, Mayuresh Joshi has joined us. Good afternoon, Mayuresh. Good to have you with us. Actually, let me start with the theme that we were just discussing in our Stock 360, the mid-cap real estate stocks. Good to chase any of them now?
Afternoon, Lata. Again, I think if one really looks at the balance sheets of these companies, they had been stressed for a period of time. But going forward with the introduction of RERA, demonetization behind us, GST largely, I think, has been captured in how Q1 numbers have fared. So to a large extent, if one really takes the view for the next 2 to 3 years, there is incrementally going to be increase in the kind of numbers that will get reported. A few of the projects, for example, SOBA has hit revenue recognition. So there were 2 marquee projects that actually did that. So there's going to be a very gradual kind of recovery in terms of demand over the next few quarters. But as this demand impetus grows over the next few years, I think these players are going to benefit significantly. Again, I think if you look at the balance sheet dynamics, the kind of receivables that are there onto their books are substantial. So as few of their projects start hitting the revenue recognition threshold, you're probably going to see numbers which can actually start compounding at a very fast clip over the next few quarters. So yes, as a theme, we do like this theme and we are very, very selective. So I think Brigade, as Ashwini was also mentioning, from the South-based players, because of its presence both in the residential place, its land bank, the hospitality area that it works out of, looks pretty attractive on declines. And yes, Kolte Patil, I think valuation-wise looks cheap. If you look at the kind of projects that it has got on hand, the kind of numbers that can actually come through bunching up of all the projects that are under progress as well, I think there can be a substantial accretion in terms of reported numbers over the next 2 years. So yes, I think Brigade and Kolte is something that I'll continue to prefer.
Okay, at the moment I can't take my eyes off the Nifty.
Yeah,
and it's a relentless climb. Reliance just goes on and on.
Yeah, and at 947.50, Reliance will cross market cap of 6 lakh crores. It's not done that yet.
Yeah, 5.97.
Yeah, because the shareholding pattern, there's been a bit of a reduction in number of shares outstanding after this quarter's shareholding pattern. So if you're going by the last quarter's shareholding pattern, it would have done that. But now with the new shareholding pattern, you take that into account. At 947.5, it will hit 6 lakh crores. Really, I think the number to watch out for after that would be the $100 billion market cap. I think it will be the first Indian company to hit market cap of $100 billion, if I'm not wrong. For that to happen, of course, it will have to hit
6.5 lakh,
6.5 lakh crores, thereabout.
Depending if the dollar weakens, then maybe.
For now, we are taking,
yes,
all things
6.5 lakh crore. I take your point. Mayuresh, Reliance.
Well, I did like that, and even on the day of results, I think looking at how the telecom segment performed for Reliance, I think it was a very stellar set of numbers. Now going forward, as the key segments, petchem and refining, will continue to perform because a large part of the capex is largely behind them. And again, even in terms of their core operations, the pet coke refinery, and again, I think the off-gas cracker coming on stream is going to substantially impact the operations very positively over the next few quarters. Having said that, I think the kind of capex that has gone both into the core businesses as well as the telecom business largely behind, and that again will mean that a lot of cash flows will start coming out of the operating assets, specifically from the petchem and refining business. The use of ethane substituting the more expensive gas that it's actually using at this point of time is also going to benefit the petchem operations. And largely, again, I think the ROEs, which have been suppressed for a period of time, I think should expand as well. So I think telecom should start contributing meaningfully over the next few quarters. The 2 core segments should do as well. So yes, I remain very, very positive onto this.
Okay, let's do one thing. We'll take a break on that.
We've got the next question here. Nagesh has written to us. He has bought 15 shares of Maruti at 2780 with a 3-year horizon. He wants to know if he should buy more. Mayuresh, looks like a sitting duck of a question. Maybe you may want to answer whether he should buy now or whether he can wait for more attractive levels.
No, the point here, Lata, again, is I think with that horizon, yes, I think he can definitely add on to Maruti on declines over the next few weeks. And as the volume growth has been very, very evident for the company over the past few quarters, that has probably propped up the earnings. So 50% plus market share in passenger vehicles itself speaks for the kind of variants that Maruti has bought from its stable and the kind of acceptance that it has got. More specifically on the UV part of the business, its share has actually gone up from 4 to 14 to 15 odd percent. So as the Gujarat plant keeps on ramping up, the operating leverage will definitely keep on coming in numbers. And as volume growth remains very, very steady and increases at a decent clip over the next few quarters, I think the earnings should also increase because the OPMs or the operating margins should be maintained around 14-15 odd percent. So an EPS around 350 odd rupees is what we can easily expect for Maruti over the next 1.5 years. So from a year's perspective, we've got a target of 8,700. But as volumes, as we are expecting, keep on coming, along with stability on margins and realizations also remaining stable, my own sense is that there is further scope for improvement and upping up the earnings estimates for the next 3 years. So yes, it's a clear hold, but a 1 year time horizon, target price is 8,700.
Okay.
Mayuresh has also been speaking with us. Neeraj, I'm coming back to you in a minute. Mayuresh, what's your pecking order in the cement pack?
So largely, Lata, again, I think if you look at the cement story, again, it's a story where consolidation is on the cards. The volumes are largely going to be a factor where realizations will account for the kind of growth that one really expects for these counters. So you're discussing Shree Cement, the kind of capacity addition that Shree Cement has done at a very substantially minimal cost has been a remarkable kind of a turnaround for this stock. And again, I think one of the key proponents of allocating capital very, very prudently. So yes, I think it's a hold on Shree Cement from a bottom-up approach. My own sense is Ramco Cements with the capacity expansions that they are undergoing over the next 2 years. A small presence again in the eastern parts of the country that should augur well in terms of a stable realization growth. As well as JK Cement, the white cement component that JK Cement has, substantial earnings improvement seen in white cement realizations over a period of time, expected to sustain. The volume growth again will give substantial leverage, and the input cost inflation has probably been very, very evident on cement companies' balance sheets. I think the demand outlook over the next few quarters might probably offset that in terms of a very positive leverage playing on their balance sheet. So yes, I think the pecking order remains Ramco Cements and JK Cements from the mid-cap pack. Ultratech remains one of our preferred choices from the large cap cement names.
Okay, Mayuresh, thanks a lot for taking time out and taking us through large part of closing bell.